Welcome to the third video in the series of mutual funds. And in this video, I'm going to touch upon the most important aspect in the overall mutual fund as a topic. I'm going to talk about the overall cycle involving four broad phases of investing through the mutual fund. Let's get on with it. Well, this diagram is perhaps one of the most important diagrams in the overall concept of mutual fund because it summarizes the overall journey in a very structured way. And as you can already see that there are four phases, four parts or four processes in the overall cycle. The first process is how would an investor, let me place the characters here. So public is here, you as money manager are here, different instruments are here, uh, the pool of money, allow me to use the word mutual fund is again here. So you see here also there is a pool which after investing perhaps grows or comes down, pool of money. Okay, so here is my explanation of these four phases. Well, there are a lot of questions, that a lot of variety, a lot of dimensions at each of these four phases. And while in the live class we're going to discuss each of these four phases, we will kind of find out answers to those questions. But right now I'm going to pose certain questions, and I'm going to do that just in a jiffy, after giving you a broad sense what's happening. The public gives money, that's where the doctors and the lawyers and etc etc but they give money to the suited booted fellow, who is a professional money manager. This professional money manager creates a pool out of that and parks the money into different securities. Phase 1, phase 2, these individual securities in which, rather than investor parking their money directly, they route their investment through this money manager. That's perhaps the reason why investment into mutual fund is called as indirect way of investment. I could have directly bought an HUL share, but I chose to give my money to Aditya Birla, who in one of their plans is investing into HUL ka share. So you see, in both the cases, I as investor get exposure to the share price and the share movement of HUL, but the two are very different. In one, I'm directly buying it through a share trading account. In other, I'm actually giving my money to the pool and the pool is buying along with many other people's money. And this pool is now converted into different securities, and the securities are going to give some return. It could be a capital gain, it could be a cash return, depending on what kind of security it is. And from this pool, from this return, how do you pass it back to the investor? So these are the four broad cycles, four broad phases of the cycles. So allow me to pose certain questions now. The first question that comes to my mind in the first phase is that there has to be a strong reason given to these public and these doctors and lawyers and teachers, etc., why they have to go through this money manager. Can you think of some of the reasons as to why do they want to go through this money manager rather than going directly and buying the HUL share? Second is, while giving their money to this money manager, they must be telling something as to what needs to be done. So this mandate is a question, what needs to be done? It's not a question how that needs to be done. That's the job, that's the responsibility, that's the flexibility you got to give to the fund manager. I'm sure there are rules regarding that as well, but mandate means what is the investor wanting the money management. So it's basically an agreement between the principal and the agent. And finally, with what frequency is this money coming from the investor's bank account into this pool? So is it coming lump sum or is it coming in parts? And that's where I bring in the concept of SIP. Okay, we'll discuss all of that in the live classes. Systematic investment plan. You would have heard about it many times, and every financial broker, every mutual fund person, and the Association of Mutual Funds of India and SEBI, everyone is crazily after this SIP. We're going to talk about that. Is SIP a panacea? Is it medicine for all cures? Okay, that's my first phase that we're going to discuss. In my second phase, I will have some problems, some questions, some debate, some dimensions around from this pool, where is money ultimately landing up? Is it going to debt or equity? Is it going for long term or is it going for short term? Is it how much is the risk that you're taking? What about liquidity? If investor's mandate was that he wants to invest only for 6 months, can I buy real estate out of that money? Can I buy, a share of a PSU firm which is going to grow but grow very slowly? All that questions are going to come up here. Which sector do I want the exposure in? Am I an auto specific or a pharma or an IT specific firm, or am I cutting across different sectors? What's the size of the firm that I am investing in? Am I investing in biggies such as HUL, Ashok Leyland, Maruti, Infosys, things like those? Or am I also okay to invest into smaller firms such as L&T Food, Suprajit Engineering, and these are some of the good performing but very small firms comparative to the other ones. So what's the size, the play around the size that this pool wants to have? So all that happens in this second stage. The third stage is rather simpler because the kind of instruments that you're going to buy will govern logically. So, what kind of returns are you going to get? So if you've bought real estate, then you can imagine that the price appreciation may not be linear. Then it's going to stay for a while, but whenever any news announcement is going to come in, it's going to jump up. So it's going to follow a step function. That's how real estate appreciation works. If you have invested into bonds, then perhaps the principal is going to remain same, but the annual accrual will happen because of the interest. But the principal value, like I said, largely will remain same. On the other hand, if you have invested into some of the smaller companies, as more famously known as value investing, if you are a fund based on that strategy, then you might suddenly experience a threefold increase. So you see, the stage three is largely determined with and by the dimensions and the decisions taken in stage two. And finally, when the money from the securities comes back to the pool, how do you want to gratify the investors? How do you want to return that money to the investor? Ultimately, it's their money. That again will depend a little bit on what happened in stage three, because if you haven't got any cash, you can't pay cash to the investor. You see, it's a pass through mechanism, people. And I am going to now create that filter, draw that filter for you. This is the filter between the investors on one hand and instruments on the other. The inflow of funds and the outflow and return. You see, it always happens through a filter. So you can imagine that whatever will happen at the fund level will automatically gets passed on at the investor level. So if the fund has a lot of cash return here, they are in a position to pay back cash as dividend or by different names called. Don't worry about the names right now. We will, look at them in the class. But just think of a situation where the fund manager has invested into real estate, and the real estate, the capital appreciation has happened. I call it capital gain, but the pool is, the mutual fund is still holding that real estate, and that real estate is still an investment. That means there is a gain, but it's an unrealized gain. There is a gain to the mutual fund, there is a gain to the pool, the value of the pool has gone up, but it's an unrealized. Can you pass on the cash return? Well, to be able to do that, I must be able to have a fungible real estate, which means I must be able to sell some portion of the real estate, which you can imagine is impossible. So imagine 100 rupees was given, 100 rupees was parked in real estate, and now the value is 120. And the investor says, can you pay back this extra 20 to me in form of cash? Because I'm a real estate, I'm a retired person, and I want to buy my grocery out of this investment. I have no other source of income. Can you, as a fund manager, sell this 20 delta so that the principal can be restored back to 100 and the excess return every time can be given back to the investor, to the public? Sometimes you see it's not possible. So you see, all these stages of the cycle needs to talk to each other. It has to be like a modeling approach where whatever happens at every stage must have a forbearance onto the stage which is going to come on, in the next stage. So the most important part here is understanding of this mandate. More formally, in your investment management, you may also listen to this as an investment policy statement, IPS. It's basically a charter which the investor is going to write and give it to the fund manager and saying, this is what you can and this is what you cannot do. This is what you have to achieve. These are the boundaries within which you can play. So it's like saying your provident fund investments, the mandate given to the fund manager is, in India, you cannot invest in equity. Star marked. That has changed, and now PF managers can also invest like about 5%, I think 5 to 15 if I'm not wrong, into equity. But by and large, the provident fund mutual money managers do not have the mandate to play with equity because there is a possibility that equity market might crash. And if, imagine, someone is getting retired in that year, he has contributed 100 rupees over a period of time, and now what he's getting is only 40. So you see, there is a major capital loss, which in context of provident fund, gratuity, and things like those, we don't want the investor to suffer. So that's where you're creating a boundary for the manager. You can do and you can't do. Okay, so in our live classes, yeah, so these are the few things that we have already discussed. So in our live classes, we are going to talk threadbare on each of these four phases, and time and again I will ask you to refer to this part, and whenever I will drill deeper, I would want you to identify which stage of mutual fund investment are we at. Because when we are talking about SIP has nothing to do with stage 2, stage 3, or stage 4. It simply means, that's my stage 4. I missed marking it here. It simply means, SIP simply means how the money is coming from the investor to the pool. And then there is a concept opposite of SIP, SWP. You would have guessed. I am sure you would have guessed SWP. W stands for withdrawal, systematic withdrawal plan. If I have, and we are going to discuss all of that, in greater detail. So basically, how would the money be paid back to the investor when the life goal comes up? So if I need to I have invested into mutual fund with an aim to, let's say, for a foreign travel. That's my goal. And I need to foreign travel into 2025, let's say, and I want a sum of 50 lakhs there. I really want to go crazy and go half the world around. Then I will not wait for entire time to pass and withdraw entire money in 2025. I will start doing it from 2024 and in parts, so that should there be a black swan event in 25, my risk gets lower. So SIP is largely a risk mitigating mechanism, same as SWP. All right, people, I'm done with this, but this perhaps a little smaller and a shorter video is the most important. So I look forward to meet you in the live classes. And I want to, as soon as possible, come to this point because that's where the meat of the concept is going to start. Looking forward to meet all of you with this concept in the live class. Take care.